Okay, welcome everybody. GameStonk. Yeah, we will be talking about GameStop today. I'll just let a few more people roll in here. Okay. Another worldly device. Right now it's 11 a.m. So still in Vancouver, but obviously not in the same place. I misjudged my planning here, so unfortunately had to do this little makeshift studio here where I'm sure you probably liked looking at the other one a lot better, but it is what it is. Get used to it. My sets will change sometimes week to week, sometimes be in the same place for quite a while. So welcome, John. Thanks for coming by. Comment on put call metrics as contrarian indicators leading up to this week. Yeah, real quick on that one. I don't, I'm sure you're referring to the extreme put call ratio that I've put together for the volatility dashboard. It's not a very good indicator for predicting spikes, right? So, and we'll talk about it a little bit later. I don't want to get too ahead of myself, but yesterday's spike was pretty much out of nowhere. Nobody could have really seen it coming or prepared. There were no metrics that I was seeing. But what the put call ratio is probably better at is getting a general idea of when perhaps the markets are ready to have a bounce and actually recover after a spike. So that's typically how I'm looking at it. I'm looking for more the sort of the mean reversion trade after a significant decline. That's when in my daily emails, you'll start seeing me refer to the put call ratio a lot more than I do now. Right now, I mean, it can stay low. It's been low. It can stay there for months on end. So it's really not a very good indicator for that, but not a bad little bounce indicator. But how many people? All right, we got a pretty good amount of people here. I do like to wait a few minutes for people to roll in, but I will play my little intro here. It's only a minute long, and then we'll get started. We're going to talk about the VIX spike. We're going to talk about GameStop, obviously. Some good stuff. So thanks, everybody, for joining me today, and hope you got a coffee. I don't know what the time will be. We'll shoot for an hour, but we'll see. There's going to be an open Q&A later. So thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. All right. Thanks for watching my little housekeeping there. So what I had planned, I can see a lot of questions coming in, and this live stream today was pretty spur of the moment. Obviously everybody's watching the crazy market action, and I just thought I'd come by and chat a little bit and maybe field some questions later on. But there's two general topics here. There's the volatility spike, of course, which was severe, as I will show you. But we also have the GameStop stuff. So I have to choose one of them to start with. I'm going to get to both of them, so I can see a lot of GameStop questions. I'm going to go ahead and default to the volatility stuff first. We'll get through that as quick as we can because I'm assuming if you're following my work, you're probably interested in the volatility stuff. And then we will definitely get into, what's a short squeeze, a gamma squeeze, and just what's going on with this insanity on GameStop and a few of the other names. So the first thing that I wanted to break down, of course, as you're probably aware, there was a big volatility spike yesterday. So we're going to try to just put it in some perspective by getting some data on where it falls historically. So the first thing we're going to look at, as you know, in my streams, I have technical difficulties, so I will occasionally be just checking to see if screen share is on. All right, all good. The first thing we can look at, so the S&P 500 was down minus 2.57% yesterday, which obviously isn't much fun for anybody who was long stocks. I was as well. I got hammered yesterday, just like a lot of other people. My portfolio was not very pleased with the action yesterday. But in the general grand scheme of things, you can see over here, that's actually only the 148th largest S&P 500 crash going back to 1990, right? We've got data here going back to 1990, and there's been 148 single days that were worse than yesterday. So I'm not saying that it wasn't bad. Of course it was, and a lot of us had a significant chunk taken out of our portfolios. But in the grand scheme of things, 148th, it's really not that historical. But what was historical, if we go over to the VIX index data, let's find this really quick. VIX, there it is. Largest VIX spikes. So these are the 25 largest single-day VIX spikes measured on a percentage basis since 1990, so the last 30 years. And you can see yesterday was actually the third largest VIX spike going back to 1990 at 61.64%. And it was only outdone, of course, by the legendary February 5th, 2018 Volpocalypse spike. And the second largest VIX spike in history, or at least back to 1990, was the Chinese stock market crash on February 27th, 2007. So that was a pretty significant event as well that a lot of the older traders will definitely remember that one as well. But as you can see, just a remarkable VIX spike yesterday, 61.64%. That is really, really a staggering spike, especially there's that S&P number. The market wasn't down that much, right? Typically, some of these, you get into the 3s and 4s. There's some 6s and 5s. There's even some of these, like last year we saw one that the market was down, of course, 11.98%. Now, one of the things that people might be asking is, well, why would the S&P be down, 148th ranking, but the VIX index have reacted so violently? And honestly, that's not really something that we can know. For some reason, the options activity, right? Remember, the VIX index measures S&P 500 options activity. It's not a tradable security, so it wasn't that a bunch of people were doing volatility trading yesterday. It was actually just that the S&P options market went a little berserk. And I suspect that's the reason. I just think that with all the other stuff happening with GameStop, we'll get into that. I just think that there were a lot of possibly hedging, possibly speculation, but certainly a lot of activity in the S&P 500 options market, which can cause that VIX index to spike violently. So that's why we saw such an outsized move in the volatility space. Now, obviously, that's not good for, say, people like me who do focus on volatility trading, at least using volatility metrics. But I know a lot of you out there as well. Vol trading is a pretty significant amount of your trading, so it was not a very fun day. Now, to get into context of what it did to the VXX specifically, these are all the largest VXX single-day spikes since the VIX futures launched on March 26, 2004. We've got a 15th ranking there. So it's significant. It made the list, and it was a 17.73% spike yesterday in the VXX. Remember, the VXX is just a 1 times volatility product. The UVXY, of course, at 1.5 times, it spiked a lot more than this. But a 17.7% spike is definitely significant. Again, kind of rare to see one on such a small S&P 500 move, but in the general scheme of things, you can see some of those other ones, the really bigger ones, in the 20s and 30s. And of course, last year during the heart of the COVID stuff, 37% in a single day. So while yesterday was certainly alarming, and it was much, much harder hitting in the volatility space than it was the equity space. It wasn't quite what it potentially could have been. So for anybody yesterday who actually got really hammered in their volatility trading, and of course, as always, full disclosure, so did I. It was not a very fun day at all. But I think that days like yesterday are a pretty good reminder that no matter what you're doing with your volatility trading, you do have to make sure that you're safe, because sometimes those moves do come out of nowhere. And there's really no telling how big the move is going to be. Yesterday, I think we got, I wouldn't say lucky, we got absolutely hammered, but it could have been worse than 17.7%. It could have easily been 25, it could have been 30. You really never know. You could get really lucky one time and the markets absolutely tank and the VXX only spikes 10%. That happens as well. But it's just a good reminder that we can't catch every crash. And that's why you always want to be prepared for it and basically plan your portfolio as if the next one is right around the corner. Because as we've seen, certainly once or twice a year, it is right around the corner. And another thing that we can look at too, I have some extended numbers here. You can see the previous day values here. And I think that this is really important. Let me just check screen share. Good. Sorry about that. Everybody knows what M1, M2 contango is, right? We talk about the VIX futures term structure a lot. The front 2 month term structure is essentially what these products are based on. So as long as there's an upward sloping here and as long as there's a decent gap between these two futures and this VIX index, that means that it's a fairly good time to be looking at short volatility positions. So anytime you see the previous day and the VIX futures market was very normal, those are the ones that are scary, right? Of course, March 16th, nobody's going to be, well, I shouldn't say nobody. There are people who short vol into crashes, which I would highly advise against. But not that many people who are knowledgeable are going to be shorting volatility into some of these very obvious moves, right? You wouldn't short volatility when the futures are steeply backward. So a lot of these you can avoid. But the real scary ones are like we saw yesterday, where there was actually no reason at all not to be short volatility heading into yesterday. We had even my more comprehensive volatility barometer, we had a reading at 50%. That's really not that bad. I'm definitely all in short volatility when I see that number. And the VIX futures at 7.15, really no reason at all not to be short volatility there. Sometimes you do the right thing and you get hammered for it. And sometimes you do the wrong thing and you get lucky. So one of those situations where it's obviously it's terrible. It sucks. I mean, losing money is it just gives you that sick feeling to your stomach. But it's also a wake-up call for volatility traders, and we do get several of these a year. I'm not saying it was historic. We get many wake-up calls along the way. But it's definitely for anybody out there who is, accustomed to naked short options and undefined risk trades, maybe shorting volatility through something like UVXY, unlimited risk plus it's leveraged. Days like yesterday can be a real wake-up call. And unfortunately, and if you're one of them in the comment section who lost too much money, we'll say, I do feel bad for you. Sorry that happened. I wouldn't say that your short vol trade that got crushed yesterday was a mistake. It probably wasn't. Like I said, there was no reason not to be short vol yesterday. But if you were overexposed, that is something that you can control. And for me personally, my volatility positions are always 20% of the portfolio. I always make sure that the instruments I'm trading are reasonably protected against a crash. So for example, yesterday I was in long VXX put options in one of my strategies, and it lost, over 12%, a one-day crash of over 12%. And the strategy was already not doing great before that, so it was a big hit. But it wasn't to the point where it puts you in a position where it's going to take years to recover from. That's really what you want to avoid. You want to make sure that when you get hit really hard by a volatility spike out of nowhere, right? If you could have seen it coming, then I guess that's on you. But yesterday, like I said, anybody who got crushed yesterday, I really don't think that there's anything terribly wrong with that. You just have to look at how badly it hurt you and adjust accordingly, because it shouldn't have been so devastating that you feel like you're years behind. And it obviously shouldn't have been a blow up situation because, VXX was only up 17%. Like I said, it could have been 30. In those short positions, I was checking some of the naked call options. One of them at the 1050 strike was selling at about 50 cents the day before, and it went all the way over $5. So you're talking about 1,000% loss on, naked calls. If you were in the business of doing that, and just week in and week out, you're making a bunch of money and it's lulling you to sleep and you think, wow, this is the easiest trade in the world. You start progressively building your courage and you take on more risk to get more premium. And then all of a sudden you get one that spikes 1,000% on you. You're in a little bit of trouble, or maybe a lot of trouble. So that was what I would assess yesterday as. It was one of those out of nowhere volatility spikes. Like I said, there are some of those. Can go over a few of these other ones too. The ones that a lot of you will remember recently was June of 2020. So let me see if I can find that one. Where's the 2020? It's one that a lot of people complain about. So let's just check what the statistics on that one were. It was a huge spike. There it is. Some people were saying that it was out of nowhere as well. And I can somewhat see that. I mean, maybe you could make a case for taking losses last year in June, because if you were just looking at the VIX futures, or if you were just looking at the dynamic relationship between the VIX and the VIX 3M and the VIX 6M, all of those indicators were pretty normal as well. So that could have been one of those just devastating out of nowhere hits as well. Now, of course, my analysis goes much further than that, and my volatility barometer was definitely showing that the overall market was very dangerous at that time. I mean, up at 70%, that's certainly not a short vol position for me. But this is what you're worried about. You're worried about days like that. This one, of course, wouldn't have been fun, nearly 10% contango. Here's one that would have been absolutely out of nowhere, and I got hit by that one. That was May 2017. I got hit twice in 2017. This one as well got me because, again, 36% volatility barometer, there's no reason not to be short vol the day going into this. And then you wake up and you're down 16% in your short vol trades. Now, hopefully you reduce the risk a little bit with put options or somehow. But the point is, volatility, while it is something that we spend a lot of time trying to anticipate, trying to analyze, and trying to make sure that we are out of trades and into safety before the spikes happen. That is what the vast majority of my work is based on. Unfortunately, there are times when you just wake up when the alarm goes off in the morning, you open your little Bloomberg and you check the futures, and you just realize it's going to be a very, very bad day. And there was nothing you could do about it. So the only thing you can do to protect yourself against those is position sizing. You want to make sure that you're small percentage of your portfolio going into vol trades, and making sure that you're not trading leverage products, making definitely sure you're not trading undefined risk options. That's where people, they blow up their account. And I would imagine yesterday was a lot of accounts blowing up yesterday. Now, obviously, they're not going to cop to that on Twitter. They're going to say, oh, and it was fine. I hedged the day before. But no, there was a lot of people who do that were definitely blown up yesterday. So hopefully you weren't one of them. And hopefully that doesn't happen very often. Like I said, it's kind of a, you never want to put a time on it, because then people might set their watch to it and they think, oh, you said it happens once a year and it happened twice this year. But it's one of those things where it's probably a once a year type thing where you're just going to get gut kicked and no reason not to be short vol. You just get hammered. So I've been doing this for so long, so it's easier for me to say this. I know if you lost a bunch of money yesterday and you're new to this, it probably feels even worse than I feel. But I've been doing it for long enough to know that this is just part of the process. You do wake up some mornings and you just get your face ripped off. So sorry if it happened to everybody. But that's the volatility spike. Now what I'm going to do, I'm just going to check out the comments really quick just to see if there's anything that jumps out as an immediate question to what I just presented there. And then we'll get into GameStop. Risking 40 by chance yesterday morning. Check the bullish. All right, I can come back to all of these. Nothing Nothing that I can just smoothly go into the answer right now. So GameStop. What is going on with GameStop? Well, I did a stream about 2 weeks ago, I feel. And somebody in the comments, maybe not that much, maybe a week and a half, somebody in the comments said, what is up with GameStop? And I don't trade individual stocks. So it's one of those things where I didn't really even know how to answer the question. I barely knew what GameStop was. I mean, I've heard of it before, but I certainly wasn't. I'm not one of these people that made money on GameStop. I did not see it coming, would not see it coming. Something like that's just never going to be on my radar. I trade indexes and I trade options, and everything that I do is looking for the maximum safety and risk management. So that's not something that I would have participated in. But the one thing that I do know about and what I can explain is the reason why GameStop is going crazy, right? And you might have heard a lot of this week, these two terms, and I want to break them both down for you just so you know what they're talking about when you see it on, CNBC or Bloomberg or whatever you follow. And that is the short squeeze and the gamma squeeze. These are two things that you've probably been inundated with, whatever news feeds you watch, constant chatter about the short squeeze in GameStop. And then when people try to sound a little bit more clever, maybe they'll say the gamma squeeze in GameStop because, that sounds a lot cooler than short squeeze. So I'll explain what these two things are, and then we can go from there. So the short squeeze, that's an easier one to understand. When you're short a stock, you profit when the stock goes down, right? So you're shorting it. Let's say you short a stock that's at $10. You're hoping that stock goes down. And you're borrowing those shares from your broker in order to execute that trade. It's not like you own them already and you're doing some type of complex thing. You're just borrowing shares from your broker. So if you would imagine what starts to happen when the stock is climbing, for whatever reason, maybe there was a catalyst and it starts going up, now your short position is going against you and you're starting to lose some money. So what you would call the weak hands, the people that maybe were too leveraged, they don't have the capital in their account to sustain those losses, whether it's they're electing to close their position or whether their broker's actually forcing them to through a margin call, they have to cover that short. And in order to cover a short position, you go out and you buy the shares, right? You just purchase whatever you were short and borrowing, and that's how you close the position. But the act of buying those shares and closing your position may actually, cause the thing to go up further. So then the medium weak hands have to close their positions. They're in the same position as before because it's continually going against more and more people. And you get this little feedback loop where the more people that are being under pressure from their short position, the more people have to go out and buy the stock. And that purchasing of the stock can cause the stock to go up further, making more people have to call their broker and cover their shorts. And again, you can see how this could be a feedback loop if enough people are short and there's a catalyst to push that stock higher. It can just keep feeding on itself, and you can see stuff, a $10 stock, a $5 stock, go up extremely high. And that's partially what we were looking at. That's a short squeeze. They're fairly common. Well, I shouldn't say common. I mean, as a percentage-wise, I would say rare, but not unheard of, let's say. You hear about short squeezes quite often, and you can check the short interest on a stock and sort of target which ones are possibly more susceptible to a short squeeze. The one that's a little bit harder for people to understand is the gamma squeeze. And I suspect on GameStop, we're seeing a little bit of both. So I should explain the gamma squeeze as well. It's essentially, it causes the same outcome, but it's for an entirely different fundamental reason. So the gamma squeeze happens because the options market is going a little crazy. So when you buy an out-of-the-money option on a stock, right, let's say it's, again, trading at $10, and you buy a $15 option on that stock. You want the stock to go up so that your option gets in the money and you can make some profit there. So on the other side of your trade, some people have this idea that some random dude out there sold you this stock and you bought it, they sold it, and it's you versus them, and you're sort of pit against each other in this zero-sum game. It's not actually what's happening. What's happening is there is a middleman there. There is a market maker. There's dealers that are actually facilitating that trade. And so what they do, because they're not interested in actually profiting from the underlying movement of the stock, they're only interested in making a little bit of money on the facilitation of the transaction. They have to go out in the open market and hedge that position so that they're not overexposed, because they're on the other side of the trade, not some person out there. The market maker has to make sure that they're flat, what we would call delta neutral, right? So delta is the option that measures the sensitivity of an option based on underlying price movement in the stock. So they go out, and the most common way to hedge out their risk on their side, which they have to do, because again, they're not trying to profit from this, they're just trying to remain neutral, they have to go out and buy shares. Now, there are other ways to hedge, but buying straight up shares is probably the easiest, most one-to-one direct way. So they just go out and buy enough stock to cover that option that they sold you. So if the option goes up, they have the shares and everything's fine. But gamma, this is where the gamma squeeze comes in. Gamma is a second order derivative that measures the sensitivity of basically delta price movements, the acceleration of price movement with respect to movement in the underlying. And it can be an accelerating factor. So imagine your $15 out of the money call. You get the stock that was at 10, it starts climbing up, right? Let's say it goes to 15. Now that $15 call that was out of the money with a lower delta and a lower gamma, now all of a sudden it's at the money, and the gamma and the delta is increased, and the exposure from that market maker is now more. So what do? They have to go out and buy more shares. They have to dynamically hedge this position as the stock is rising. And what does that cause? Could potentially cause one of these feedback loops where the dealer has to go out and buy more shares, and then those options become more and more in the money. And then, of course, market makers are always opening new out-of-the-money strikes, and more people are buying those. And then those out of the money become in the money. It raises the gamma exposure of the market maker. They have to buy more shares. Stock goes up even further. And again, you can get one of these really odd, doesn't happen very often, feedback loops. One might be able to make a case that that's why we've seen the stock market rise so much. Things like Tesla, things like Apple, the broad stock market. You could make a case that this is sort of a gamma squeeze type environment, not at the same extent as GameStop, but a sort of a mini gamma squeeze, essentially, where there's a lot of options being bought and sold, which is why we see the VIX index, persistently high, but the market climbing to all-time highs. It could very well be this sort of dynamic of feedback loop at work. So that is essentially the difference between a short squeeze and a gamma squeeze. They have the potential to lead to the same outcome, but for a fundamentally different reason. So the short squeeze is just because, shorts have to continuously cover their position, and that can push the stock up. And gamma is those out of the money options getting progressively closer to the money and in the money, causing the market makers to have to continually buy more shares to hedge their position and hedge out that risk. So when you get two of them together, you get maybe a little bit of a short squeeze, a little bit of a gamma squeeze, put it all together, and basically what you get is something like this. So this is GameStop. Check if I'm on screen share. Good. This is the now infamous GameStop. Now it's still at 230. I'm surprised it's been so resilient, but you can see that before all of this happened, it wasn't that long ago that this was a $5 stock. Right? And it wasn't that long ago at all. It was just, a week and a half ago where it was a $20 stock. Now, what can end up happening, of course, is you need something to light this fire. So the way that I think about this is something like GameStop is what you want if you're a buyer of the options or a buyer of the stock and you're participating in these little forums. You want just to create this massive bonfire where the thing goes out of control and everybody who's long makes a whole bunch of money, right? You need a couple of key ingredients to make that bonfire. The first one, consider the wood, right, that you pile up. The wood that you're piling up is the short squeeze. You want something that has high short interest. Now, oftentimes high short interest just means high short interest. There's no resolution. It doesn't mean it's going to spike up. It just probably means for good reason there's high short interest. So that in itself is just a pile of wood. The gasoline might be your gamma squeeze, where you have an underlying stock with high short interest and you've got a lot of options being traded, especially out of the money options. Now you've taken your pile of wood, your short squeeze, and you've doused it in gasoline, which is your gamma squeeze. But still, you've just got a pile of wood doused in gasoline. You actually need something to, light that and get it going and create this massive bonfire. So that's where things like Wall Street Bets comes in, and all of these people making YouTube videos, pumping up these fairly low volume stocks. These, I don't know what GameStop was at before. It was probably I'm going to take a wild shot in the dark. You're probably going to fact check me next live stream, but probably a $2 billion company. I'm guessing. I have no idea. I'm just going by the stock price. Wouldn't even have been that big. I don't know, but I think it reached something insane, 30 billion valuation or something. You get a lot of people who are pumping these things up. They're making videos. They're talking in Reddit forums. They're actually able to light that fuse. And of course, that's what Wall Street is angry with, because that's Wall Street's trick. The whole pump and dump, that's what they've been doing for 30, 40 years. That's what all these hedge funds are doing. Where's the difference? They're essentially scouting out stocks that they have chosen, that they have positioned in, and now they're going out and telling everybody how awesome they are. They're going on CNBC, they're going on Bloomberg, they're going on all these things, telling everybody it's a great stock. You get Jim Cramer out there hitting the buzzers and the horns and doing his thing. Where's the difference? Why can people not have a forum like Wall Street Bets? Why can't they be the match that sparks that bonfire? And I think that that's what we're seeing today. We're seeing this real battle between the old bag of tricks that Wall Street has been doing for decades colliding with the social media world, this new phenomenon where, 10 years ago, this just isn't possible. The old trick 10 years ago was to find a stock that maybe looks a little bit shaky, and you release some type of scathing, libelous report, basically telling them that there's accounting fraud and it's going to zero. And then you're already pre-positioned and you watch the thing collapse. That's not really possible to do 15 years ago because you just can't get the reach. But nowadays with social media, that Wall Street Bets forum that we were all sort of interested in recently, that I knew hardly anything about before a few weeks ago, you go on there and you realize, wow, there's 2.5 million followers. There's 800,000 people with capital ready to allocate in these forums. And even if they have a tiny amount of money, even if their trading accounts, just all of them together are only $5,000 accounts, you get 800,000 people doing the same trade with a small account. Well, there you go. It is enough to, light that bonfire, which is just a pile of wood doused in gasoline. Now social media can light those fires. And that's what Wall Street is not really appreciating now, is that they're seeing the result of that. And of course, we have heard stories, and it's hard to gauge how accurate the stories are, and we still have to wait for all the dust to settle here on how much losses they take. But we have heard that there are some hedge funds that are actually trying to fight against this by maintaining their shorts, doubling down on their shorts, trying to fight it. It didn't work. The thing skyrocketed even further. And now we are in a situation where you're starting to see, well, I'll just say it, outright corruption, attacking this stock, basically. What ends up happening is, down here, they don't like the fact that funds are losing money. So they've got a few tools at their disposal. They can raise the margin requirements, try to squeeze out a few of the people, make sure that not as many people can continue to do this trade. Well, that didn't work. The stock's still going up. So what else can you do? Well, you can limit the number of trades that people can take. You can say that there's no complex options allowed on this product. Okay, we'll stop people from doing that. Okay, that didn't really work. It's still going up. So what do? Well, you raise the margin requirements more. You start reducing people's ability to trade more because they're trying to save their financial industry friends here from taking insane losses. And of course, the elites in the financial industry, and whatever you want to label them, the man, whatever, they do have quite a few tools at their disposal. But this was one of those cases where at every step of the way, they tried to crush it and it just wasn't working. I mean, it was really resilient. When you see something like this in a stock that's already gone parabolic, this is typically the beginning of the end, right? You'll see it crash like that, just a cascade downward. And that's not a small move. That's from 318 down to 218, right? It'll recover a little bit. And then this move down, you could completely forgive people for, bailing out on this right there on that bar. That's pretty much what I was expecting to see, but it rallies. And so now they have to reduce trading further, and they have to limit everybody's choices and raise the margin requirements, and unbelievable resilience to go up to 500. And then again, you see one of these cascade spills downward. That's got to be the end of it, right? That's it right there. No, it recovered. It went back up. Then it cascades way down, but still back up to 300, bouncing around at 220. This thing is unbelievably resilient. And I think, I'm no expert on these things. I'm not in the financial industry. I've never worked in the financial industry, but I suspect there's a lot of people, they see the writing on the wall here, and they see that there's an animal been released here, and it's sort of all bundled in together with the social media animal that we are all trying to cope with and deal with. And it's affecting all of our trades, whether we want to acknowledge it or not. The collision of social media with the trading world, it can have serious ramifications now. I mean, in 2021, in 2016, we would say, that's adorable. Look at these retail people. They're trying to influence the market. 2018, there was a couple instances where they, some significant things happened, but still, it's just Robinhood. Just ignore those Robinhood traders. Well, now we're in 2021, and turns out if you get 1 million people together in a forum with a little bit of cash, each one of them, they can inflict a lot of pain on these larger funds. Now, you won't see this happen on Apple. It's a market cap that's way too large, but you can see it continue to happen on smaller issue stocks. So the last thing I want to end with here, because I do like to balance things out, I want to issue a little small warning to all of you, because what you're going to see in the next several months, and maybe the next several years, is you're going to see a lot of people on Twitter and on YouTube and, these forums who are going to be selling you courses and selling you subscription services, teaching you how to find the next GameStop. They're going to be in the business now, talking about gamma squeezes, and I've got the next one, it's this one. I want you to understand that these things are very rare. And like I said, just because there's high short interest, typically that just fizzles out and dies. The short interest is there for a reason. It's a garbage underlying stock, and nothing is going to happen. The vast majority of the time, that's the case. Gamma squeeze the same. Just because there's high open interest on out-of-the-money options, you can screen for all these things. Just because that's the case doesn't mean that you go out there and you start laying significant amounts of capital trying to find the next GameStop. All right, there's going to be tons of people convincing you that they can do that. And essentially, here's what their business will look like. You can go to a free stock screener, right? This is finviz.com. Anybody can go to this thing. Just click on screener, click on all here, and you can just start adjusting these things, right? These little categories. So the first thing you want is optionable and shortable. So first of all, I'll untick that. You can see we're starting with 7,632 stocks, right? Obviously, you can't trade 7,600 stocks, so you want to make sure that they're optionable and shortable. Now we're down to 4,388. The next thing you want to look for, and it's been ages since I've looked at this, so now you want to look for high short interest, right? Remember, that's the wood. We're trying to build this big bonfire, so I wish somebody could help me out here. My eyes are okay, this will do. What's the maximum we can do? Over 30%. Now we're down to 56 stocks. Okay, and what are some of these stocks? Well, they've been in the news recently. There's AMC. AMC's been going crazy. Let's go to the next page. There's our old friend GameStop right there. Just two screens. We've got 56 stocks. There's a lot of people out there that are going to be telling you that this is how you find the next GameStop, and now you just slap a bunch of money on all these little names here. You can even go a step further. Remember, you said it has to be a somewhat small company. So let's say from 300 million to 2 billion. How many have we got left? We've got 18. Okay, we've got 18 little stocks. that are 18 little potential bonfires here. We've got high short interest. We've got optionable. I didn't even screen detailed wise to see how much out of the money, and you can do all that with Thinkorswim. There's going to be a lot of people telling you that this is the thing. Send me your money now. I can find you the next GameStop, and then we're just going to buy out of the money call options on all of these things, and we're going to make $1 million. So just be careful that this is the financial industry. And like I said, we are seeing trading colliding with social media. And there's going to be people out there trying to take advantage of others who, maybe you have a cursory understanding of what a gamma squeeze is. You saw it in the news somewhere, and you might be susceptible to paying somebody a bunch of money when really these things are completely unpredictable. I mean, I would never tell anybody what they should or shouldn't do with their money. So if you want to do this, go ahead. We narrowed it down to 18. Do your thing. For me, this is not something that I would invest any capital into. It's, trying to find the next one. You'll have so many losers for every winner. And again, it's not going to be GameStop, right? This was just a wild, bizarre thing. We're not going to see another GameStop a month from now. Now that I've said that, it's going to happen. But we're not going to see something that goes from $4 to $550 that is a garbage stock. They're probably going to put a lid on this somehow. They've already tried. They've already tried. So the lid will be put on this, and it will be very difficult to scour for the next one. But as you just saw, I could sell you a subscription right now, right? I just showed you how to screen. I've narrowed it down to 18. I know the next GameStop. If you send me $500, I'll tell you what option strikes to buy and sell, and I'll tell you how to make money off this, right? I have a following on social media. I could do that. So that's what I would caution people against. It's one thing to understand what happened, very important. It's quite another thing to actually successfully seek one out and succeed at it. Most likely, it'll just fizzle out. Short interest remains short interest. Out of the money options remain out of the money options, and they expire worthless. That's most of the time what's going to happen. Now, again, I'm not telling you can't, but I would say be careful. Keep your allocations very small. You want to buy some type of $2 option, okay, fine. But don't dedicate too much of your capital to this thing. The seeking out of the next GameStop. But I can see it now. There's going to be a lot of services popping up in the next couple of months trying to do this to people. So if you want to know how to do it, email me, teach you how to do it for free. I'm not going to sell it to you. I can show you. That was just a FinViz public screener. We got it down to 18. We can do way better than that. We can narrow it down. We can look at the level 2 options. We can do all these things. And I could make it look like I've found the next one when really I'm just rolling dice. So don't pay me money for that service. Don't pay anyone else for that service. It's not worth your money. So that's it. I will leave my little presentation there. We talked about volatility quite a bit. We talked about gamma squeeze, short squeeze, GameStop, AMC, BB, all these fun things. Now, we still have a little bit of time left. I do want to thank everybody for showing up. It was kind of a spur of the moment thing. Usually I give more heads up. As you can tell, if you've been following my streams, I have moved. So I have a little makeshift studio here. I will be doing more streams, and I'll plan a little bit ahead of time. So, and most of them will be volatility related. I think my next stream, just to give everybody who's watching here a heads up, I'll just choose a topic, talk 45 minutes, open it up to questions, and we'll talk about how much volatility products decay, right? So I want to actually show the real numbers, because you get a lot of people online just giving absolutely made up numbers. I want to show you how much these products actually decay week to week, month to month. Go to the VXX, go to the UVXY, and actually show you the true decay factor, so that when you're planning out your short vol trades, at least you have the right data. Nothing makes me more angry than when I'm on Twitter and I see people posting data and it's just so obviously plucked out of thin air. It's just, they didn't even spend 5 minutes in a spreadsheet. It's so far off. So that's going to be my next live stream, and look forward to that in a few days. All right. Let's open it up to questions. Just scanning here, I can see GME just everywhere. I'm going to go back to the top. So if you're asking recent questions, I just don't want to skip over any of the really good ones that came before. So scan slowly. I'm on the move. I'm traveling, so I don't have two screens. Apologize. I have to sort of look down here. I know it's not professional, but I travel light and I travel often, so I'm a one laptop kind of guy. Christian Herzog says, even my German broker now blocked opening new positions. Yeah, it's not just that. I had an email this morning pre-market, and somebody asked me what they should be doing. How do they play this? And I basically said, you can't play it. There's just too much risk on both sides, and there's too much volatility to buy any options. So you can't fight that Vega headwind. But I said, I'll try a couple of trades. I'll just take one contract trades. I'll take 3 or 4, and I'll just make a video out of it, and I'll actually show people how they respond. So I was thinking doing a naked short put, right? That's always a good trade. If something has gone way up, you can sell some ridiculously low strike, and there's still enough premium there. So you could sell one $20 GameStop put or something for a month out. And then you could do a butterfly, just a long butterfly at some much lower price. You could take the 50 strike and do a 25, 50, 75 butterfly. I could take a vertical spread. You could do the 195 vertical spread, long put vertical. I was just going to take a bunch of them and show them. And then I log into my Thinkorswim and I want to take these trades, and every one of them's denied. Thinkorswim can't open any positions, can't do any options trading. You can only close positions. So anybody who's sort of late to the party here, I'm sorry, you missed it. I missed it. I didn't participate in this. Don't have any interest in participating. If I can't put it in a spreadsheet, if I can't quantify what's going on, I don't trade it. So this is something that it went right over my head, and it's too late now. They've been completely shut down. Here's one that's more specific to VTS. This is a public stream, so I do private. I'll do private streams for the VTS community, but this is one that just stood out. Last 2 months, we consistently get 3 to 4% up on the portfolio, and a single day loss wipes out most of it. Should we take some profits off or reduce the exposure when the volatility is 50 to 60? Yeah, it's been a real. Sorry. Oh yeah, I am on this. It's been a real frustrating time, and what you're describing, that's happened 3 or 4 times in a row now. It's extremely frustrating, where of course I'm a trend follower. So one of the main things that gets me into a trade is the trend is looking promising. And then the thing that gets me out of the trade and into safety is when that's no longer the case. So you do have to take a loss in order to be kicked out of the trade. That's kind of how trend following works. If you want to roll the dice and be one of the contrarians, or be somebody who thinks they have a functional crystal ball and they can actually predict things, be my guest. I've not had any luck with that at all. So for the last 10 or 12 years, I've been a trend follower. I'm a tactical rotation trend follower. And that does mean that you're going to take a loss before you get kicked out into safety. Unfortunately, the way things have looked for us, can pull up the Thinkorswim here. Unfortunately, it is a situation where we have had some rather big single day or 2 day drops only to see it recover, right? And that's kind of what we're seeing now. This one kicks you out. It was down 2.57%. Everything was fine on what was it, Monday, Tuesday. Everything's fine. Our portfolio's just plugging along nicely. And then all of a sudden, out of nowhere, you get hammered. That kicks us into safety. Now, ideally, it would have been a down 1% move. Remember when I sent the email in the morning to all the community, the S&P was only down 1% and we exited completely to safety. But by the time the market closed, it was down 2.57 and it was a very painful loss. But that kick out to safety is useful for us. Like, we actually, I don't want to say I want to lose money, but that is the only way to get out to safety, because I don't make any forward predictions based on my gut instincts. Everything is based on price action, market action. You can't get out of a trend if the trend is still working. The only way you can get out of it is to get kicked out of it, forced out of it. And unfortunately, with our portfolio, VTS portfolio, especially the tactical volatility strategy, is just, it's just been uncanny. I mean, it's going well, everything's fine, we're in a trend, and then one day you get kicked out. It has to exit to cash because it's a safety strategy, and then the very next day it recovers. Fortunately today, or not fortunately, but just interestingly, it actually hasn't recovered that much. So the stock market's been recovering, but this premium on this June put option isn't that far off from where we sold it yesterday, or from where I sold it yesterday at market close. Hopefully some of the others in the VTS community got out earlier than that. But, I got out, I think it was 9:30, and it's only at 9:65 now. So the VXX actually isn't bouncing back nearly as strong as the broad equity market is. So that would be something to maybe pay attention to if you're not yet in safety. Typically, there's going to be a bounce after a crash, and then the real test is the second day. So the real test will be tomorrow, what happens tomorrow. If we have another fantastic day in the stock market, then probably the trend is broken and things might actually go up. Might go up. I don't know. But if tomorrow's a bad day, that could be a sign of trouble. You get the big crash, you get a little bit of a bounce, and then the trend reveals itself that, down is the new trend. So we'll see. But yes, valid question. It's been a frustrating period for my strategies, certainly. And I'm keeping an eye on it, and I'm never against making changes if necessary. We're a long ways away from that, but yep, I am aware of how much whipsaw there has been recently. Do I think the market is going to keep ripping higher? I have no idea. I'm surprised it's where it's at, so I guess that's my answer. No, I don't think it's going to keep doing that, but it absolutely could. I don't see what everybody's so excited about. I mean, certainly I'm not saying I'm an old school fundamental type of person. I'm not. I'm day-to-day quant based on volatility metrics, but at the same time, what's everybody buying? I mean, there's zero fundamentals that would put us here, but here we are. That's why I trade price action, because I don't know. I wouldn't want to base anything based on valuation. I think we should be 30% lower right now. But that would have been very costly for me if I actually aligned my portfolio for that prediction. So thankfully I didn't. And, we had a good year last year. January this year has been rough because of yesterday, but it's just one day. Here's one from Hans. Was yesterday evidence of ETP crowding the close, or just that SPX dropping last 15 minutes? Yeah, it was just one of those days where volatility reacted a lot more to what was going on than the S&P 500 did. And, yesterday with about 30, 45 minutes to go, I think the S&P was maybe down 2%. It had gone, first hour of trading, it was down 1%. Volatility was spiked. Then it was down 2%. Volatility reacted very harshly to that. And then the last 30 minutes plus the little 15-minute aftermarket, there was just a violent reaction. So, like I said before, that could very well just be a function of the market right now. That's a lot of people want to participate in the uptrend, but they also want to remain hedged, and there's a lot of speculation and hedging in the options market. And that could be why we're seeing volatility remain so sticky. Here's Mark. Are we looking at the worst month return for tactical volatility? No, but I think it's third. I think May 2012, I lost 26% that month. August 2017, I'd like to say 21. And this month, I honestly haven't added it up, but just doing the quick numbers, we had 3 losing trades this month. I'm going to say 19, something like that. I mean, brutal for sure, and not happy about it. But no, not the worst ever. The benefit, obviously the downside is you lose a bunch of money, and especially when it was going pretty well and then you just get gut kicked. But the benefit is with short volatility, if you do catch a trend, then that magnitude of losses can be recovered. Now, whether it will or not, that's just a forward prediction. I don't know, but it can be recovered. Like I said in my email this morning, as you probably read it, you always want to live to fight another day. And taking a 20% loss is not fun for anybody, but that's not nearly as bad as it could have been. There was, a lot of ways that people could have been short vol yesterday that would have been fairly unrecoverable. So we will look for a new trend, and we're in cash now, and The way volatility looks, we might be for a little while longer. Okay. And this is the same question. Yeah, I just answered that. Yeah, it's been we've been whipsawed probably 3 times in a row now. It's so frustrating. Yeah. Now, one thing I will say, I don't want to get too into it because this is a personal VTS question, but if we look, remember the portfolio is designed with different strategies. So, for example, when we moved yesterday from the NASDAQ to the utilities ETF, we did take a loss in the NASDAQ. It was still up money, that trade. It was very well, and then it got hammered down about half the size, but it was still a profitable exit. But then getting into utilities, this trade is actually up today. So we can see that, we moved into VPU, but it's up, nearly 2%. So that's a little bit of a recovery there. And the offsetting safety positions, IEF is down 0.25 and TLT is probably down, minus 0.67. And then we are still short vol through the SVXY, and that's up as well. So you get hammered, but the portfolio is never going to be completely on the wrong side of the trades. We're never going to be in a position where, just you're in total safety and then the market recovers and whipsaws you to the point where you feel like you got hit twice. We kind of get hit once on the big move down because we were totally long the market yesterday, and then kind of a half hit on the way up where we moved into bonds and they're down a little bit as well. So yeah, not fun. But we do have some trades that are up today as well, so it should balance out. Won't balance out, but you get my point. Is gold a hedge? It depends. I think it depends how it's being used. When I enter gold, it's typically when the markets are the most weak, when the volatility metrics are just screaming warning signs. That's when I'm going to be moving into gold, because historically, that is a trade that can still make money when the markets are collapsing. Of course, the danger with holding something like gold, holding something like bonds, is if the market does have one of these quick reversals, for whatever reason, all the fear from yesterday just immediately leaves the market, and today the market shoots up higher, then you can get caught holding something that can be down. So I don't think gold is a safety position or a hedge necessarily. It's a speculative position that you're looking to profit from. So when, for example, my strategies, the tactical balanced moves from equities, the bulk of it, about 60% of the time we're in equities, about 25% of the time we're in bonds, and then the remaining 15 we are in gold. And equities is to make money, clearly. The safety position of bonds, I don't care if it makes nothing, it's just safety. And then gold is there to make money. And anytime you're doing something to make money, it's speculation and it can lose money. Gold can lose. You could wake up, you're in gold, you think everything's fine, the market's crashing, all of a sudden it recovers the next day. You could see your gold position down, 4 or 5%. It can happen. So I wouldn't consider gold a hedge. No, I would consider it a hopefully inverse correlation to the equity market. Doesn't always hold, but hopefully that's what you're looking for. This is an interesting one. Esteban says, looks like the whole market gamma squeeze is due to the stimulus checks. This is something that you see. I know him. He's not saying it condescendingly, but this is something that you hear a lot about the stimulus checks. Again, it's a little bit, you're treading on a line there where we're kind of dismissing the whole, Robin Hood the crew, the Wall Street bets, the people who got their stimulus checks and ran out and bought out of the money options. If 220 million Americans got a stimulus check and 2 million of them were in the Wall Street bet subreddit, there could be something to that. I don't know. It's interesting. What we're seeing is unprecedented for sure. But here's one. Dan, while GME was going crazy this morning, I purchased bull spread through. Wow, you got something sold. You got a complex trade done. I wonder, Interactive Brokers. Wow. Yeah. Yep, that's what happened to a lot of people. like me, I just found out before I even got a trade done that I was shut down completely. So at least you got something. You got to play a little bit there. Sold minutes later at 4. Hey, so you get to say that you profited from the GameStop stuff. Awesome. The GameStopalypse, the Volpocalypse of GameStop. Yep, you participated and profited. Good job. I was not that lucky. I was going to go the other way. I'm always looking to avoid paying that much Vega if I can. And what you did was actually a good trade. When you're doing a vertical, you're largely canceling out that Vega, right? You're selling one, buying another. So whether you do a long put vertical or, short call vertical, whatever it is, as you said, a long bull, a bull put spread, you're essentially canceling out that volatility. So the fact that it's got IV of 500% is less relevant to that trade. And you can still make money doing that. What you don't want to do is just buy individual legs in put options. I have a video on YouTube talking about that with specifically to the VIX index, where what a lot of people think the holy grail trade is, you just wait till it shoots to the moon and then you buy put options, right? So in the COVID crash, it gets to 82.69, hasn't been that high since October 1987. So of course, just buy put options. The problem is you're paying so much Vega for that position that even when it goes down to 20, you still lost money. So I think you made the right call trying to get a complex spread in there, a vertical spread. You beat me to it. I suspect my $20 short put option would have done well as well, but they didn't let me do it. This one from Bryce. I like to trade SVXY. Subsequent to Volmageddon, the product was amended to make it safer. Question: do you think there is still a possibility that following a day such as the one we had yesterday, or worse, a number of consecutive days, I could wake up one morning and learn that my position lost 90% of its value, like we saw in Feb 2018? So I did a live stream, just the last one that I did, talking about October 1987 and what that would have done to the volatility ETPs. And you can pretty much guarantee that it would have collapsed all of the inverse products, including a 0.5 times SVXY. It probably would have terminated that as well. Probably would have terminated a midterm one like the ZIV. It just would have been a complete annihilation. So to answer your question, yes. Yep, you could do that if you are in... Certainly, it sounds like you're going to let your position go a few days, right? If you let it go for consecutive days and you don't take the signals to get out, yeah. In a one-day kill shot, it's going to take a lot to kill a 0.5 times SVXY. Could happen, but it will take something major. But 2 or 3 days, absolutely. If you're going to be stubborn with it and you're not going to just take your licks and get out, then yeah, you could find yourself just bleeding more and more capital. Day 2, you wake up, wow, it's going to go down again. Well, I guess I'm going to hang out again, just take more losses. Then day 3, wow, it's down again. Think back, we've been in a buy the dip environment for a couple of years, but think back to Q4 2018, where it started on October 5th, right? It was bad. There was a lot of people who were saying, oh, this is short-lived. It's fine. We can just keep holding our short vols. We can just add more layers to the short vol. When it cascades downward, you just get twice as much profit. And as it turned out, it just crashed for 3 months straight and blew up many, many people's accounts. So yeah, that can happen. Like me yesterday, I can't even tell you how bad I didn't want to take that loss. But when it's time to move to safety, you move to safety. Like I said, you got to live to fight another day. So don't be too stubborn with your short vol positions. Here's one. How long have we been going for? Wow, there's a lot of people here. Thanks, everybody, for showing up. Sorry it was so spur of the moment, but I feel like today, yesterday, just the craziness. You don't often see that. It's definitely warrants a live stream when we see the third largest VIX spike in the last 30 years, up 64.61%. Yeah, felt like I should jump on and give a little bit of context to what's happening. Let's do that one. More questions. There's a lot of questions today. I'll just keep going. Julian asks, do you think there is another leg up in the VX futures? I mean, that would be a market prediction. That would be just me saying, I think this is going to happen for no other reason than I think that. I tend not to, I really try to avoid making personal market predictions. I know that sounds bizarre because we are allocating capital and it sounds like we should be making predictions, but that's just not how I trade. I'm data driven. So the only way I can answer that is if the VIX futures do continue for another leg higher, I have a plan for that. I have trades that will deal with that situation if it comes. If it drops down, we've got a plan for that. Doesn't mean we always nail it right. Sometimes we get it just completely backwards and get crushed, but I've got a plan for that. And I do need to wait to see it happen before actually following through with that plan. Logan says, so I shouldn't buy GameStop Nokia naked. Well, I mean, even if you could at this point, no. When something's moving that fast, there is no plan. There is no way to protect your risk. Let's see where this thing is at now, just as I've been speaking. Where are you, GameStop? How's the VX? VXX is going back down again. I put on a little position today. I just sold 50 puts. I got in it. I mean, this was just this morning. It's already down, so that's pretty good. GME, very resilient. It's still hanging in there. I still think I'm going to log in one day and it's going to be $50 or lower. I mean, honestly, where should this be? Well, once the mess starts to be fully realized and backed out, we could see this thing go back to $5. I mean, why not? It's not worth more than 5. The market has spoken for a very, very long time. It's not worth more than 5, right? Where was it before COVID? 11? Went all the way down to 3. We could see GameStop at 5 within the next month. So where was that question? Something like, should you buy it? Yeah. So I shouldn't buy. I don't know. No. I don't tell people what they should or shouldn't do, but I can only tell you what I would do, and I would not, even if I was allowed to. I was, like I said, I was only going to play around with a couple of trades just to do a before and after, just show people what are the best trades to take when you see implied volatility that high. And for me personally, you definitely want to favor the short put options way, way down. If the IV's high enough, they can still pay off. And there are ways to fix that trade if it goes against you. Verticals are fine because you're sort of partially eliminating that implied volatility problem. Butterflies are fine. Even broken wing butterflies, you could choose a side, break the wing and make sure one side has no loss potential and the other side maybe has more loss potential. Those are the types of trades I do. But if you're just buying something or selling something, like long or short, flip a coin and hopefully it doesn't move $400 on you in 10 minutes. Yeah, I wouldn't touch it. That's the thing. You got to understand there's so many ways to make a good rate of return safely. Whenever people ask me, well, should I do this? Should I sell naked calls on UVXY? No. No, you shouldn't, because we're trying to be in this for 30 years, right? Don't think about what you're going to make this week. Think about what you're going to make 30 years from now. I want to be able to look back on my portfolio and I want to be able to say, you know, one of those things where you see on Twitter sometimes, if you only would have invested X amount of dollars in this and kept it there, you would have had an insane amount of money, right? I want to be a manager who people honestly look back, not this year, 20, 30 years from now, they say, if I only trusted that guy, you know, he had losses, he took big losses. If I only trusted him and just hung out for 30 years, boy, did he know what he was doing. He made a consistent 15% a year, you know, averaged out for 30-year career. That's awesome. Never got to make 4,000% on GameStop, but had a pretty nice run of very consistent returns. That's what I target. So all of those questions that are sort of in the same ballpark of should I do this risky trade? Should I jump into this insane market? My answer would always be no. And if you are going to do it, keep it small. Keep those allocations as small as you can. I am not trying to be the best manager this year. I'm trying to be the best manager for the next 30 years. You know, when I'm I'm 45 now. When I'm 75, my piece of art will be complete. But right now, it's just a couple of scribbles on a canvas. But eventually, the whole thing will come into play and be like, oh wow, that's actually pretty nice. I wish I saw it building as it was going. That's what I'm targeting. So I'm probably the wrong person to ask if you're looking for recommendations on risky trades. It's not my wheelhouse. This is interesting. Jerome asks, there might be a link with the Fed meeting. Do you see any edge at using some kind of major events, special filtering? No, I have not. I'm not saying it doesn't exist. There are macro traders out there. I'm not impressed with the general performance that I see in people who try to do that, because I've got a YouTube video. Let me get you the exact title of it. There's my YouTube channel. I did a video recently. Now it's a Biden backdrop. So Biden-Trump backdrop. Ignore that. Double uncertainty. Hopefully that brings it up. This one right here. Maybe watch this video and that'll give you a better understanding of what my answer is going to be. But the reason that I don't try to take in any event risk at all is because there's double uncertainty. So the first uncertainty with any one of these things is, what is the actual outcome, right? If it's a Fed meeting, what is the actual outcome? We don't know whether they're going to raise rates or keep rates the same. So that's uncertain. But even if we did, even if I had a, perfect clairvoyance to the future and I could know for sure, wow, the Fed's going to drop rates by, 0.25 basis points. If I knew that ahead of everybody, I still don't know how the market's going to react to that news. Sometimes they lower rates and the market shoots higher. Sometimes they lower rates and the market tanks. So you can never get around the double uncertainty principle with investing. You don't know what the outcome is. And when you find out, you don't know how the market's going to react. It's the same as an earnings event. A lot of people think, oh, the earnings are going to blow the doors off, so I'm going to buy the stock. Really? First of all, you don't know if they're going to blow the doors off. They might tank, so that's uncertain. And secondly, what if they do blow the doors off and it's sell the news and the stock crashes anyway? That happens all the time. So for us to pretend that we could even factor in event risk and Fed meetings and fiscal policy decisions and debt cliff, negotiations or elections, I keep that stuff far away from my tactical investing. Julian, thank you. Yeah, as you all start to get to know me better, I'm very new to the live streams, but just remember, I'm a completely open book. You can ask me anything. And worst case scenario, I will tell you that that's a little bit too close to proprietary information. I'm not going to divulge the actual strategies that I use, but yeah, I'm as open as I can be. And honest about things. I will never hide my trading losses, and I will never brag at my trading victories. That is, both of those sides are not my style. I'm a former professional athlete, if you consider golf a sport, or I'm a professional gamer, if you consider golf a game. But that's the one thing that you learn when you're playing professional at a level is be humble in your victories and don't be afraid to just go face on with your losses and just accept them and own them and go straight to the media. When you tanked the tournament, I bogeyed the last 4 holes and I lost the tournament. Don't go straight to your car and go home and try to hide from it. Don't try to, I'm not going to take any interviews because I'm too upset. No, you suck it up. You go straight to the media tent and you do your interviews. And that's what I do. I don't, with my trading, I have no problem telling you that yesterday was not fun for me. But I'll be back. I'll live to fight another day. Dan again. Well, Dan, you're the one that made money doing it, so GME is not a viable strategy. I consider the bull spreads as lottery tickets. Yeah, good way to think about it. Like I said, I'm not going to tell people not to do it, but take Dan's advice there. Keep it small. Understand that this is mass speculation. Nobody should be selling their car to buy lottery tickets. If you want to buy a lottery ticket, it should be with the $10 you have in your pocket. It shouldn't be a significant amount of your capital. So you want to play around with these things? Like I said, awesome. Go buy some out of the money calls, use a screener, find the 18 stocks with the highest short interest, the most options activity, out of the money options activity, and buy one single call option, buy junk options, $1, $2 out of the money options. And let me know in a month how it goes, but make sure that if you did lose on every single one of them a month from now, that it's not going to affect your P&L that much. That's what I would say. Yeah. Marius, GME has huge IV, so it's good to sell a small put. Yeah, naked puts, and even if you sell them cash secured, they're not without risk. People should understand that anytime you're buying options, buying or selling, it's not an expiration type thing. You should never look at your option and say, well, it's never going to get to 20 a month from now. Or if you're selling some type of UVXY out of the money call, there's still premium, $10, $15 out of those strikes. A lot of people catch themselves saying, well, it's not going to be at this price 15 days from now. It's not going to be at that price. So I'm safe. Options trade dynamically second to second. So just because something's way, way out of the money doesn't mean you can't get into margin issues and you can't see your dynamic profit. You should always be looking at your actual profit curve. I'll give you an example here of, maybe a trade I just sold this morning. Like here, I sold a naked put option on VXX. So I sold 50 contracts. I was going to sell 150, but I wanted to leg in 3 ways to see if VXX would go down further and I could actually get better prices, which it's doing pretty well. So maybe I'll buy more or sell more tomorrow. But you can see this pink line. That's what you want to be focusing on. This turquoise line, that's just an expiration, right? I shouldn't really worry about the expiration that much. What I want to do is make sure that at no point on this pink line, I can get myself into trouble. Because if something tanks really quickly, even though you think, oh, it's so far out of the money, it's never going to get there. Well, remember, it doesn't have to. Options trade dynamically minute to minute, second to second. So you can slide down these profit curves and be losing a lot of money, even though if it expired there, you'd be fine. It's not about whether I would be fine 3 weeks from now. It's about how is this trade going to move on me, a minute from now, a day from now, 2 days from now. Always look at your profit curve. So I would say yes, with IV through the roof. Yeah, what happened? Oh, I lost a light. Tried to have a little makeshift studio here with some lights and I lost one. Yeah, with high IV like that, I would say that whatever you're doing, you want to avoid buying that premium. So selling a put, fine. But just remember, it's not completely risk-free. I would much rather be on the selling put side, but the reason I do it on VXX so often is because, of course, it's not a stock, so there are ways that I can save that trade even when it goes badly. That's our vol trend strategy in the VTS options portfolio. Matthew, thanks for showing up. First time. Yeah. Just started these things. So I suck at it. I know I suck at it, but it's been a personal challenge for me. I like to do hard things and I am deathly afraid of public speaking. So this was something that I embarked on this year. All my videos for the last 5 years are all edited and scripted and even those I'm nervous doing them. So this is butterflies for me, but thanks for checking it out and hopefully I get better over time. Fabio asks, where am I? I'm still in Vancouver. I totally misjudged my paperwork. I'm trying to open another company and I just misjudged the mail and it's Canada. Everything's unbelievably slow in this country. So yeah, I might be here for a little while longer. Bing bong, these names. It's nice that during such crazy days you like to discuss about it. It is a special week and a lot of us learn. Yeah. I don't know. Sometimes some of the best lessons are some of our biggest mistakes or some of our biggest losses. It would be nice if for some reason it wasn't like that, if life wasn't like that. But yeah, you got to face it. You got to just talk about it, figure out what happened. Unfortunately, like we said, there was really no reason So it's not like this is a learning experience. I mean, all I can learn is I had the right position on yesterday. If this exact situation materializes again, I'm going to be short vol heading into it. There's no way I mean, it might be different because the tactical vol doesn't directly trade from the barometer, but yeah, I can't look back and say it was a mistake. I just can say that the market kicked me in the teeth. But unfortunately, this is one of those things that there isn't even really a lesson to learn. It's just, you just got to talk about it. And I was hating myself. I told my community this morning that I ate, I said half a pie. I probably ate 2/3 of that thing, 2,000 calories of apple pie. And I was not a happy guy yesterday. What is this asking? I might not be able to get this one. Could you explain how you account if you do not roll for the spread? Sorry, I don't know what you're getting at there. Ask again, and maybe at the bottom. I'm a little behind here, and the stream jumps on me. I haven't figured out my software yet. I don't know why. It just freezes for a while, and then it jumps past about 20 comments. So I'm definitely trying to get to as many as I can here. Oh, here we go. Eric, favorite active UFC fighter. I hate picking favorites in anything because, I mean, favorite movies, I like top lists. So let me pick top 3. Dustin Poirier is one of my favorites, always has been. I thought he was going to get smoked in that Conor McGregor fight. I thought he was going to get knocked out in the first round, but he is one of my favorites, has been for a long time. So I was happy to see him win and make, over $1 million for a single night. But Dustin Poirier, Kamaru Usman at 170. I'll always look forward to watching him fight. And then obviously my favorite fighter is John Jones, but I always kind of put him 3rd or 4th because somebody in the comments going to be talking about PEDs and steroids and all that stuff. But yeah, John Jones is kind of my favorite fighter. So there's 3. And they're all doing well, so happy about that. Tim, what is this one? What is a high profitable and high probability VIX index option strategy in backwardation? Well, I think I retweeted today one of my older articles. One of my older videos. Again, I like to point to them so that you have the right one to search. This is the YouTube channel, and what you're looking for is this one. VXX versus 3 times long stocks. And in this video, I do a study where I basically show that the most efficient way to short volatility when the VIX futures are in backwardation or even flat, the most efficient short vol trade is just long stocks. Because when you pair these two against each other, right, at least in the long-term beta factors, the VXX and the UPRO are very similar products. UPRO is 3 times stocks, and the VXX has a beta factor to the S&P of about 3 point something, 3.3, 3.4, depending on the period. So those are basically the same thing. Leverage factor long-term. Of course, day-to-day it fluctuates a lot, but the long equities is a short vol trade. Like, a lot of people think short vol has to be a volatility product. Everything we buy that's correlated to the stock market is a short vol trade. So I would say that the easiest and safest would be just long equities. I mean, you're not going to get your head ripped off if it goes against you, but if the market recovers, that is the most direct way to profit from it. Because if the VIX futures are in backwardation or close enough to it, where are we sitting right now? So we've got some roll yield here. So you're not going to get totally ripped off. I like that blue Corvette. But it's still going to be more efficient to be doing equities. Until you get a significant roll yield and backward or contango going here, long equities is going to be the much safer play. Just bang for your buck, I would say stick to that. And in my case, for my defensive rotation strategy, VPU, utilities, a utilities ETF. You don't have to use the Vanguard one, but that's a pretty good short vol play as well. I know it sounds like a long utilities ETF. How's that short vol? Yeah, we would benefit if the market goes up, which is essentially stability in the volatility market. So yeah, it's hard to structure when in backwardation. I tend to either be in cash or look for re-entries to equity positions. Okay. Could you make a live session explaining the options graphs? The options graphs. Which options graphs? Are you meaning what I just showed a few minutes ago? Like trying to explain more of what you're looking at here as a general picture? Or do you mean specific to our VTS options portfolio? You'd like me to go over what those individual strategies are? Let me know. Still got a little bit of time to hit me with a few more questions here. We've been going for, what is it? Almost an hour and a half. Jim Bradley, thanks for dropping in again. Yeah, 160 watching. That's pretty cool. I have no idea how many people watch streams. I know that it takes months to really build up a following, but hopefully people are aware that I make these now, and we can just get more and more people asking questions. And ask me anything. Volatility related, equities, personal to my VTS community, options trading, whatever you want. Not saying I'm an expert in everything, but whenever I'm not an expert, I will directly tell you that's not in my wheelhouse, and I try to stay in my lane. So I'm not going to be speaking on anything that I don't have personal experience or expertise in. I will just punt on the question and say it's not my thing. Like playing with GME, GameStop. Not my game. Ramana says, is it a good time to buy volatility? Seems like a top. Top in the markets, I would assume you're saying. Good time to buy volatility. I would say it's not far off, but it's too early. I have the same mindset as you, that the best time to buy volatility is not in anticipation of an event. That's obviously almost always a losing trade. You never want to be that contrarian where volatility is super low and then you buy vol in anticipation of something. Probably you're just going to bleed your capital. So I actually wait till the event starts happening, wait till it gets to a significant scary part, and then I feel okay buying vol. Because at the very least, you want that VIX term structure to be heavy backwardation, no roll yield, negative roll yield. And that way, if the markets do reverse on you, you have a little bit of a buffer zone there where you don't get completely destroyed. But if you buy volatility when it's not yet completely started to melt down, you could find yourself in one of those reversals where, you can lose more than you were planning to lose. Esteban, yeah, thanks for dropping by. Anytime you have to go, there's a rebroadcast in these. Again, I suck at YouTube, so I don't know exactly how that works, but as soon as I end the broadcast, I think in about 2 to 3 hours, there's a rebroadcast. So you can always catch it. But thanks for dropping by. I really appreciate it. And for all of you as well. You can follow me on Twitter. There's my handle down there. I will always give some type of heads up. Today was sort of spur of the moment, so I didn't really do much there. But definitely follow me on Twitter. Just go there, type in @VolatilityVix, give me a follow, and you'll always be notified of when I'm doing the next one. TN, why do you prefer VXX over SVXY? Well, I use both, so I don't prefer either one. My tactical volatility strategy shorts volatility using what is called stock replacement, where I'm actually buying in the money put options on the VXX. And I'm not really worried about the implied volatility or the actual option Greeks. It is just a pure short vol position where I'm just trying to capitalize with a certain delta factor, the VXX hopefully going down. So if I'm got a 70 delta on a long sort of 130 days out contract, if the VXX goes down, I get to participate in about 70% of that move. And then the aggressive vol strategy, we short vol by buying the SVXY. So I use both. I think they're both fine. I talked about it in my last stream. A lot of people complain about SVXY being a deleveraged product. I actually don't mind it. I used to like the old ZIV. So for me, whenever you get risk management that's actually built in, if you start from the point of risk management, you can always add ways to make more money. But what you don't want to do is start from risk and then trying to scale it all back. That ends up costing you a lot of money in the process. You have to massively reduce your exposure. That costs money. You have to hedge it. That costs money. You have to get out extremely quickly. You can't let it go even one day. That costs money. So I always like to start at a base level of safety as close as I can, which VXX put options do that and SVXY does that, and then maybe look for ways to kick it up a little bit. So I like both equally. Well, I like VXX puts better, but they're both good. I'll put this on here, but I feel bad asking. Everybody knows that the YouTube algorithm does like the like button. So if you could do me that favor and just hit that thing for me, that would be fantastic. GTE. Well, let's look at what is GTE. I don't really trade individual stocks, so especially small names. So I don't oftentimes know what these are. That's an ugly chart. That's a 2-year chart. I'd like to look at 1 year. Okay, so, well, this is from 18 cents to 62. Yeah, I guess they're still going. Is this another Wall Street bet? Let's just see what the market's at. It's dropping back a little bit, only up 152. I don't know. What is that? You'd know far more about it than me. I mean, anybody who's in the comment section, if you ask me to look at a certain stock, very good chance I don't know what it is. I trade mostly indexes, ETFs, and options. So here's a question, and I will get into this more. So I'm going to do a private VTS live stream just for paying subscribers, probably on the weekend. So I'll do another Saturday session where I skip the whole. For people who are new here, I did a whole 45-minute spiel on the VXX spike yesterday, what's a short squeeze, a gamma squeeze. We talked about all of that stuff. I'll skip all that. We'll just get straight to the questions. I've got a whole community of people who are, we're all licking our wounds here, and I definitely want to be available for everybody to get all of their questions answered, because the worst thing, I don't mind losing money. Right. And I suspect a lot of people who follow my work understand that losing's part of the process. But I can imagine what would be even worse is if you have unanswered questions, confusion, and you're losing money, and you're asking questions and you're not getting answers. So absolutely, I will take as much time as you guys need. We have a large VTS community, private community, and I would like to have, we're never going to be able to make it better, right? The only thing we can do is just keep following the strategies and hopefully recover. And like I said, with short vol, it's possible that it can be recovered in fairly short order, but we can at least acknowledge and accept it and understand it. So stay tuned for that. I will shoot out an email as soon as I'm ready. All right, doctor's appointment. Hopefully nothing serious. Thanks for showing up and supporting the channel. Really, really appreciate it. Follow me on Twitter. You'll get notified of the next one. And ask questions. Here's another one. GSAT. I wonder if this is... Are you trolling me? Are you trying to make me show how many people? 180 people? Are you trying to get us all to go buy this thing? Look at that one. That wouldn't be a bad plan. Like I said, there's... Oops. No, don't open Zoom. Like I said, we're seeing a real collision here of social media and investing, where what we would just a dismissing amount of retail traders these days, I think we have to start taking people more seriously. So if people start, I'm not Dragon Lord. I think it's Dragon Lord. I'm not saying that you're one of them. I'm just trying to make a point that people who do that, who go into YouTube comments and pump stuff up and who make YouTube videos. Maybe it's a well-presented YouTube video. You're making a case for why Blockbuster, why Blockbuster should, we should give it a second look maybe. I don't know. Those things might actually work. Like I said, you've got the short squeeze or the short interest, which is the pile of wood. You've got the potential gamma squeeze, which is the gasoline that you're pouring onto it with out of the money options. And then you just need a pumper who, makes a credible presentation on why we should take these things seriously, like why I should care about BlackBerry. And there you go. You might actually light the fuse. Who knows? That would be... this is why I made that warning earlier, because this is going to be an entire spin-off segment of the market now. People are going to be marketing like crazy. The next GameStop, the next AMC. Be aware that it's just, investing isn't that easy. I wish it was. I wish that I could, in a perfect world, I've told you I'm the type of person that is going to be extremely happy if my entire career I have a 15%, 18% annualized return. That's going to be awesome. 30-year career of making 18% a year on average. I would consider that a fantastic job well done, especially now. In the days of Warren Buffett, he was at about mid-20s, but that's including the 60s to the 90s. That in this day and age, 10 to 15% is pretty much crushing it. So I wish there was a way that we could just make 1,000% and we could just seek out all these, the next GameStop, and we could just crush it. Get it all done in a year. Let's build our wealth this year, not 20 years from now. But I'm telling you, it's not going to work. All of these people that think that they're going to take a small amount of capital and turn it into something big, it's the same mentality that people think they're going to go to Vegas and suddenly they're going to be the one that wins. And believe me, the casino will let you play. You're going to be able to do this on many other things because the longer you play, the more money you'll lose. That's just how this works. There's no quick path to making a bunch of money. And anybody who thinks there is, usually you get a real rude awakening. You get a wake-up call, and the market will do something like it did yesterday. Or the regulators will you'll have this perfect trade going, and then they'll just shut you down and halt the stock, and all of your options expire out of the money, or whatever it is. Yep, that's very true. We all want to be rich, but unfortunately the best way to get rich is to make a reasonable rate of return for 30 years, have yourself a good job, make money. I know this is boring stuff, but it's what I do and it's what I preach. Make money, be frugal, be a minimalist, stuff as much money as you can into your investment account. And believe me, 20 years later, you're going to have all the money you need. But if you try to do it this year, you might lose 5 or 10 years on your timeline. Remember, time is the most important aspect to building wealth. And if you do stupid things and you lose 5 years of your trading account because you just took a massive hit, there you go. Major setbacks cost you the most key, precious thing that we all have is consistent returns over long periods of time. That's how you make money. This guy, Dragon Lord, you're killing me. The next GameStop, there it is. Thanks for your videos. I feel there would be a lot of copycat attacks on GME like small cap stocks. Any ideas on how to benefit? Well, yeah, you're probably just coming into the stream, but I actually went over this not too long ago. Here's what you're going to see people doing. They're going to teach you how to do stuff like this. So I'm going to teach you how to find the next GameStop. And bear in mind, I'm being facetious here. You're not going to find the next GameStop. But this is a public stock screener. Everybody can use it. We're going to go in here. All the stocks right now, 7,632 of them. Okay. So obviously we can't buy options on all 7,600. First thing we screen for, optionable and shortable. Now we are down to 4,388. The next thing we screen for is high short interest, float short over 30%. Now we're down to 56 names, which does include the recent massive winners like AMC and GameStop is in here as well, right? It's probably still in there. There it is. So, I mean, we feel like we found it. There's 56 names here, right? All we have to do is make sure that the market cap is small enough that we can influence the market with our, 500,000 members with $5,000 trading accounts. Here's your 18 names. You've got 18 names that this is how people are going to tell you to find the next GameStop. And then they're going to even be more than that. And they're going to go into their Thinkorswim or their platform stock screeners. Interactive Brokers has a good one as well. And they're going to actually start showing you why this out of the money options activity is going to spark the fuse on the next GameStop. So to answer your question, yes. Where did you say that? I feel there will be a lot of copycat attack. Yes, there will be a lot of people that are trying to duplicate this success. Now, I don't mind if you do it on your own with small amounts of money. But what's going to annoy me a lot over the next couple of months is when people start launching subscription services telling people what I just showed you in 30 seconds, how to use a stock screener. This is not high level stuff. Finding, small cap stocks with high short interest and lots of out of the money options activity, so you get the potential short squeeze and the gamma squeeze. This is not high level information that I just shared with you. What I just showed you is not worth $5. But there's going to be people out there that are going to be selling you that for hundreds of dollars, thousands of dollars. Mark my words, you're going to see a ton of these services essentially doing what I just did there. Maybe they'll sprinkle in a little bit of, level 2 analysis or whatever they do. Trust me, it's not worth $4. But there's going to be a lot. This GameStop phenomenon is not over by a long shot. It's probably over in GameStop. The powers that be have done what they can to shut this down, and they'll probably be successful. At some point in the next few days, maybe a week, we're probably, don't put a single dollar on what I'm about to say, but we will probably see GameStop have some kind of a spectacular crash down to something more normal, something in the, I would say at least where it all started. So you're looking at a spot of about 20 there. I would say something like that is the range that we're looking at. And realistically, I would say probably something in this range a little bit further out. So, but like I said, we're not going to see the last of this GameStop stuff. There's going to be tons of people talking about this constantly. So if you missed the early part of my stream and you don't know what I'm talking about with gamma squeezes, just go back and watch the rebroadcast. Again, I want to stress so many times, this is not high-level information. You might think, wow, this guy's sharing the secrets. It's not. This is nothing. If you think that information is good enough to make money on, boy, that's why subscription services exist. If you knew how much work goes into my service, it would take me 2 years to break down all the data. I just did the short squeeze stuff in 20 minutes. It's really, really not complicated stuff. Don't let somebody sell you what's worthless. Mark, do you feel with the economy at the moment, it's better to be in more cash? Again, I'm very data driven. I structure all my trades tactically over a 1-day period. So I only know today. That's it. I wake up in the morning. I wait about an hour or so after the markets have been trading just to get rid of that early market chop. And then I input a massive amount of data into my spreadsheets. And based on that data in that moment, all my strategies make their tactical decisions for the day. And then, of course, this is a public stream, so you're not probably in my community, but if you were, you'd get an email about 2 hours after markets open with my trades for the day. And those trades are valid for the next market day. So I won't ever really try to go further than 1 day. And if you force me, like gun to my head, yeah, the economy's not good. But I don't want to say anything that would put somebody in cash, because I can tell you from experience, I probably answer emails for about 5 hours a day. It's a significant part of my day. Probably work 10 hours a day, and half of that is just answering emails. And so I can tell you over the years, thousands of people have literally thousands of people have told me that the economy's bad, the market's at a top, I can't pull the trigger, I can't get into these trades. I cannot tell you how many thousands of people have told me that. Looking back, I've just made my consistent return. I've managed risk the best I can, and I'm not, a GameStop millionaire, but I've done pretty well. And if you're in that mindset of trying to match the economy and your gut instincts with your trades, it could lead to, negativity bias, ostrich bias, certain things that might keep you on the sidelines or certain things that might get you allocated when you shouldn't be. I would recommend you take a very short-term look, be data specific, quant based, look at price action, look at what's going on in the moment. And I don't plan for Monday. I know what I'm going to be in tomorrow, Friday, because I decided today based on Thursday's data what trades I'm going to hold overnight into Friday. And tomorrow I'm going to, if necessary, I'll move out of some of them. If they're good for another day, I'll hold over the weekend and reassess on Monday. That's how I attack the markets. So this is an interesting one. I don't want to give anybody any ideas here. Is there a small cap ETF to benefit from GME? So essentially what you're looking at, no, not the financials. It's been so long since I've looked at, I've looked at these retail sectors. I'm going to open up my Twitter account, actually, if you don't mind. And while I'm on here, if you don't mind just firing off, follow me. Just go on to @VolatilityVix and follow me. But I did tweet out this morning. Conveniently, I can just find it because I don't offhand, I don't really know what these obscure ones are. Where's my chart? How far back do I have to go? How often? I don't tweet much. So this one here, XRT. So what XRT is, make sure I'm on my screen share here. XRT is the retail sector ETF for the S&P 500. And if we go to, like I did here in this chart, you can see that the S&P 500 is the lighter sort of turquoise line, and the XRT, dark blue, is the retail sector ETF. And it's up 40%. Obviously, obviously heavily influenced by what's going on in these very small retail names. So if you're blocked from trading the GME, which of course at this point everybody is, you could possibly look at some trades in XRT. Now again, what I would recommend people do is always make sure that you're trading small, because this is entirely unpredictable and anything could happen, right? It's down 8% today. You don't want to go into this thinking, wow, it's a broad market ETF. It's all a retail basket. What's the worst that could happen? Well, a lot of bad could happen. And if you're trying to short it, it could go the other way. It could go up 20% on you or something stupid. So I'm not showing you this to encourage people to say, oh, well, my broker won't let me trade GameStop, so I'm just going to go into XRT and I'm going to do all these crazy trades. You could do that. I don't think there's any limiting factors at all in XRT at this moment. Not that I've heard of. But again, keep it small. Make sure that you know what you're doing. Always limit risk. But that's what I would recommend, is that you want to go for a broad basket ETF that has a heavy retail focus, which of course XRT is the retail ETF. Sober Capitalist. VIX term structure chart is rapidly changing by the minute. Can you go over it quick with your thoughts? Where is it? How do you mean? Okay. Yeah, it's different than it was a few minutes ago. The VIX is certainly on the rise. That's what I said. Like the market, I'm not so sure. To see the market bounce a day after such a catastrophic loss yesterday, that's not that uncommon. To see a little bit of a bounce the next day, I wouldn't say it's predictable and you should stay in trades one extra day. You shouldn't. Like I exited to safety. I took my losses. You just take your hits and you move on, because when it's time for safety, it's time for safety. You don't want to be in a situation where, like for me, taking even a 4 or 5% portfolio hit is certainly better than hanging in there and suffering a 20 to 30% drawdown. So I get out of there and I get to safety. But it is one of those unfortunate sort of whipsaw things where sometimes you have to say, well, I exited yesterday, I took all my losses, and now today, look, the market's up. But what can happen, you're really looking for day two. That's what's really going to give you a much better picture than the very next day. The next day, typically, I'd say on balance, you're looking at a small bounce, at least for the morning session. And then after that, you're going to get a much better idea of what's going on. So Friday, tomorrow, I'm heading into Friday mostly in safety positions. And if the markets are up, then that might signal that over the weekend, some of the risk is going to come off. But we could see an acceleration to the downside tomorrow. So you always want to wait for confirmation of the signal before reacting. That's how I would answer that, is that the VIX term structure is certainly important in your trading. You want to be aware of what it is and how it can affect the ETFs that we trade and what it represents in the actual market. But at the same time, you do want to wait for confirmation of signals before reacting. And right now, we've got 1.6% contango, basically very little roll yield. Remember, the VX30 is a combination of both of these. Got tons of videos on that if you don't know what I'm talking about. The difference between this green line, the VIX, and these two futures, the average of these two futures, that's what we call roll yield. It's pretty benign right now as well. So there's no signal here. For me, there's sit and wait. Sometimes the hardest thing to do is to take your losses and sit on your hands. But right now, that's the only choice we have because the market's not giving us any clear sign of a trend. Trendless market means it can go either way quickly. All right. Well, an hour and 50 minutes. Let's shut it down there. So thank you so much, everybody, for coming on the stream, asking all your questions. I really appreciate the support. Like I said, I'm learning how to do this. So if you come in and check out the streams, you're kind of watching me get over my fear of public speaking and trying to present something better. So like I said, just a heads up, follow me on Twitter. The next stream I do, or maybe the next stream, I haven't decided, I'm going to talk about the actual decay of the volatility products, how much you can expect in a week, in a month for the VXX, just so we know ahead of time. You can sort of plot at least the long-term average decay factor for all of us volatility traders out there. So I'll give you a heads up, and hopefully you have a great day. If you participated in GameStop and made money, congratulations. Be careful out there. There's a lot of weird things happening. So thanks, everybody.